Hello everyone, this is an attempt at my first YouTube video. I tried posting one before for another class, it just didn't work. So I'm trying to get the handle of how we do this. I think my problem is that I use an iPhone and then I'm trying to upload an iPhone to, you know, a Windows-based computer and then back and forth, so somehow it's just not working. So I don't know, I got some work to do. I got to try and figure this out, but anyways, let's just get going. So again, chapter 14, dealing with bonds and long-term notes payable. So first we're going to start dealing with bonds. Okay, we've talked a lot about, not we've talked, but I've heard a lot about bonds in the news lately due to COVID-19. We're having the economy collapse, so governments are issuing bonds and guaranteeing bonds. So before we go any further, as you were able to tell from that email, what we're going to be working on today is questions. I want you to read page 916 to 925 and do QS 14.1, 14.3, and 14.4, along with exercise 14.1. Okay, so first of all, let's talk about some characteristics. What exactly is a bond? Well, I guess before we get into exactly what is a bond, let's look at some of the learning objectives, what we're going to cover in chapter 14. So we're going to compare bonds versus share financing, okay, and why a company might want to issue bonds rather than shares, okay? Explain the types of bonds and their issuing procedures. Prepare entries to record bonds issued at par. Determine the price of a bond. Prepare entries to record bonds issued at a discount. Prepare entries to record bonds issued at a premium. Record the retirement of bonds. Explain and record notes. Okay, so the notes of the financial statements. Prepare entries to record lease liabilities. And we're going to look at the debt to equity ratio. Okay, so again, you're following along on the slides. Okay, we are now on slide 5. So what is a bond? Well, first of all, a bond is a written promise to pay an amount identified, okay, as the par value of the bond along with the interest at a stated annual rate. Okay, so you'll see a variety of examples. A company may issue a $2 million bond like we see on page 919. Okay, so the par value of the bond is $2 million and whatever the rate will be. Now, if I look here, the interest rate is 6%, okay? So we know that this company is gonna pay back not only the initial $2 million, but they're also gonna pay back interest at a rate of 6% per year. So 6% times 2 million, we're looking at what, 120,000? 0.06 times 2 million. 0.06 times 2 million. $120,000. Okay, so depending on if the payment is semi-annually or annually, okay, that'll all determine the amount. Okay, so when we have the liability, so the liability for the borrowing or issuing corporation, okay, that's a liability. So if we go out and we need to raise money, okay, we can either raise money through shares, issuing shares like we covered last chapter, or we can issue a bond. If we issue a bond, that's basically a promise to pay back that money at the end of the bond's life, okay, which may be 5 years, 2 years, 10 years, whatever. Plus, the company is also going to make at least semi-annually or annual interest payments, okay? So there's two cash flows that the bond investor is going to get, okay? So if we look more at some more bond characteristics, okay, we have the stated interest rate, okay? So the stated interest rate it's also called the coupon rate, C-O-U-P-O, coupon rate. Okay, it's sometimes called the nominal rate or the contract rate. Or the bond rate. Okay. Why? Well, because that's the amount of interest that the bond is going to pay to the bond holder. Okay. So the interest rate is always quoted at an annual rate. Okay. So let's just say we go and sell a bond, again, $1 million bond. That's referred to as the face value. Now, we also might have, well, we're going to have an interest rate, okay? So let's just say we have a 4% interest. Okay, that is the stated interest rate or the bond rate. So in this case here, okay, 4% at $1 million, that means that the company who sold the bond is going to pay the bondholder 4% interest on $1 million. So that's going to result in $40,000 for the year, okay, of interest. Now, we also have to be aware of another thing. Is that interest paid annually, semi-annually, or quarterly? Okay. So, interest payments. Let's just say the interest payment is semi-annually. As a result, what we have to do is we have to take that 4%, which is $40,000 of bond interest. We're going to pay that interest payment semi-annually. So let's just say that we sold the bond on January 1. Okay. We're going to pay interest semi-annually. So we're going to make a semi-annual interest payment of $20,000 on June 30th, and we're going to make another $20,000 interest payment on December 31st. Notice the total's $40,000. Okay, but since we're paying a semi-annual interest payment, we take the 4% divided by 2, which gives us 2% times the face value of the bond. Okay. So that's how bond interest rate calculations work. Okay. Now, okay, great. So we talked about the basics, but why issue a bond? Okay, why not issue shares? Go get a bank loan. Well, maybe the bank doesn't want to give you money. Okay. You don't want to sell shares for whatever reason. You don't want to dilute your shareholder base, so you issue a bond. So the advantages of a bond are they do not affect shareholder control. Okay, if you issue more shares, you're going to have an effect on control. The interest that you pay on those bonds back to the bondholders is tax deductible. Okay, so while it may have cost us $40,000 of interest, okay, we got to claim an interest expense. Okay, so that's going to benefit our company. Also, bonds can increase the return on equity, so that's important as well. What are the disadvantages? Well, if we go sell shares, no one's saying we have to pay a dividend. Okay, but with a bond, we have to pay back that interest. Okay, so every 6 months or every year, we got to pay an interest payment. That's cash coming out of the company's pocket. And at the end of the bond's term, whether it be 5 years, 10 years, whatever, we have to pay back that full amount. So we sold that $1 million bond. So not only are we going to pay back $1 million at the end of the bond's term, we're also paying $20,000 of interest on a semi-annual basis. Okay, so it can add up because again, the disadvantage is that bond requires both an annual interest and par value payment at maturity. Also, bonds can decrease the return on equity. Okay. So I'm going to stop here. That's 10 minutes. I'm going to make another 10-minute video where we talk about bond types.